p.m. I believe it's 1:45 on your side, right? So in the next 30 minutes, we will introduce you to the world of technical analysis. And at the end, we will spend around 10 minutes for Q&A session. So for those who are the first time to attend our webinar, I'd like to make a brief introduction about Formax Group. So Formax Group started operations in 2010, and in 2013, the company launched a product called Copy Master, which allows you to copy trades from professional traders. And in early 2014, the company participated in the IFX Expo at Macau and launched its ECN account, which stands for Electronic Communication Network Account. So basically, this account can allow people to trade faster and with minimum cost. And 1 month later, as you can see, the group launched its operations in Hong Kong and UK. So now, the group has 7 subsidiaries across the globe. Of course, it includes the India. Next, about my company, Trading Central. So we are founded in 1999, and we have a track record of around 15 years. So now we have office in major financial centers, including Paris, London, New York, and also Hong Kong. As you can see on these slides, we have received many certifications and awards during the past 15 years. If you are interested, you can simply search those names on the internet. So I won't repeat one by one. But finally, let me just tell you one more thing about Trading Central, which is not listed in this slide, that we are licensed by the major financial regulators, including the SEC in the US, the SFC in Hong Kong, and also AMF in the Eurozone. All right, let's see today's plan. First of all, we will go through the definition of technical analysis. Then we will study the key concepts of technical analysis, including trends, what are trends, and what are support and resistance. After that, we will introduce you 2 of the most important technical indicators, the relative strength index and also moving averages. So after we learn all of this, we will combine all the tools and apply them to a real-life example. So hopefully at the end of this webinar, you will find your time is well spent. So what is actually technical analysis? If you Google this term plus definition, there should come out a variety of terms, but more or less the same. So here we write down one of them, one of the definitions, but personally I'd like to quote John Murphy's classic book, The Technical Analysis of the Financial Markets, which says, technical analysis is the study of market action primarily through the use of charts and for the purpose of forecasting future price trends. So in other words, technical analysis is the study of past price action to forecast future trends. But why do we need to study the past? We believe that there is nothing new under the sun. What happens in the past will happen in the future. And this is the first principle of technical analysis. History repeats itself. So the second principle of technical analysis is that we believe price action or market action can discount everything. Even unexpected events such as earthquakes will be reflected in the price very quickly. The third principle in technical analysis is that we think price move in trends. Think about it. If price moves randomly, then nobody will constantly make money in the long run, right? But of course, this is not the case. We can see many successful traders who consistently make money. So the next topic, trends. How do price move in trends? We know that trends are the directions of price movements. So basically, there are three kinds of trends: the uptrend, the downtrend, and also trading range. If we observe higher tops and bottoms, the trend is up. Lower bottoms and tops, the trend is down. And in a trading range, the price actually moves sideways between the support and resistance. We'll come back to the support and resistance later, but here, let's simply see an example of trends. As you can see, here is a daily chart of the Aussie dollar, and together we have some indicators like the moving average, the Bollinger Band, and in the lower chart is the relative strength index, the RSI chart. So as we can see from this chart, what is the trend? Can you observe the trend in this chart? You can simply focus on the price bars and ignore those red line, blue line, or those indicators, and think what is the trend of the market. Well, now let's come to the answer. As you can see, I simply draw some lines on this chart, and which shows an uptrend during the first 3 months, the first quarter of 2014. And then in the middle half, we have a trading range. Then after September, we can see the many downtrend. Of course, it's not necessary to draw the lines. As we can see, we mark down here some tops and bottoms. For the first part, you can have higher tops and higher bottom is uptrend. And for the middle part, it's trading range because we don't have a significant direction. And in the third half, we can have lower tops and lower bottom. Of course, it's downtrend. Let's see one point particular important is in September when the price bounced but failed to break the previous top in July. So actually this is the first lower top. So as we can see, 2 days later when the price breaks below the previous bottom, we have lower tops and lower bottom, which means a downtrend began. And the price dropped a lot after that. So how to benefit from the trend analysis, or how to trade this trend? Very simple. In an uptrend, we buy on dips, buy early retracement. And in the downtrend, we sell on rallies, sell early bounce. And in the trading range, we simply buy low and sell high. Buy near the support and sell near the resistance. So here comes to the concept of support and resistance. As you can see from the left half of the chart, the above is the support. What is a support? A support prevents the price to fall below this level. So at a support level, many new buyers will enter the market and push up the price. So that's the support level. And as a comparison, a resistance level will prevent the price to rise above, because there will be more sellers to enter the market at this resistance level. How can we determine the importance of different support or resistance? Well, we can simply count the number of price tests. Say in the above chart, we have 3 price tests, and in the lower chart, we have 4 price tests. of course, the lower resistance is stronger than the above support. The next question, what level should we select as the key support or resistance level? Let's see an example. Well, here, as you can see, is the monthly chart of euro-dollar. Many people may think, does technical analysis work in such a long time frame? Well, let's take this example and prove that it works. So let's see the level of 1.2, the key level of euro-dollar. As you can see, in the past 10 years, the price dropped to this level, 1.2, for 4 times, and it all rebounds. So here, 1.2 level is a key support level. And before 2000 and before the 2000, we have one resistance at 1.2 level. When the price bounced around this level, it cannot stand above. So it used to be a key resistance level, and after 2000, it's a very strong support level. Here is one principle called polarity of the support and resistance. Simply speaking, the past resistance can become the future support, and the past support can become the future resistance. After we learned these two basic concepts of technical analysis, let's introduce two very important technical indicators. As technical indicators, they are different from the economic indicators because we calculate or derive these indicators mostly from price only. The first one we'd like to introduce is the moving average. If you add the closing price of the past 10 days and divide that by 10, well, you get a simple 10-day moving average. That's it. Very simple. The concept is very simple. So why the number of 10? Because in the old days, when there was no calculator or there was no computers, it would be much easier for people to calculate a 10-day moving average or 100-day moving average other than 9-day or 11-day. But of course, nowadays, we can use any number we like because of the use of computers or calculators. But normally, we can have short-term moving average, say 10 days, 20 days, or mid-term moving average, say 50 days, and long-term moving average, say 100, 200-day moving average. And of course, for the intraday traders, they can have 20 minutes moving average, or simply say 20 bars, 50 bars. It depends on your time horizons. But on the daily chart, we can simply take the 50-day as the midterm. And lower than that, we can have short-term moving average. Bigger than that, we have long-term trends. So let's take a look at this chart on the left. We don't know what asset it is, but it doesn't matter because we focus on the price. So as we can see, the blue line is the 50-day simple moving average, and the middle red line is the 20-day moving average. Then you may ask, what is the other two red line? Well, that's another technical indicator called Bollinger Band, where most people or traders like to use. But we will focus on the moving average on this chart. So take a look of this blue one, the 50-day moving average. Well, as you can see in 2012, the direction is up. So it means the trend is up, daily trend is up. And of course, you can have the rising 20-day moving average, the red one. It also confirms the trend is up. So moving average can be used as a trend identifier. The second use is to generate buy or sell signals using the cross of price with moving average or the crossing of long and short moving averages. In this example, we can have the red 20-day moving average cross below the 50-day moving average in April, the mid-April. As you can see, the price draw down a lot, so it means a trend reversal. And of course, some people may use the price penetration as a sell signal. Then you will have a sell signal basically in late March, which is a little bit earlier than using 2 moving average. This is one drawback of moving average, because moving averages are lagging the markets, lagging the price. So you have to be quite careful when using it in real-time trading. Okay, let's see another important technical indicator, which is called relative strength index. As you can see in the title, we have the RSI, short for relative strength index. We also call it oscillators. Why do we call it oscillators? Because the indicator will oscillate between a range between 0 and 100. It's unlike moving average. You don't have a range. So this is the second type of indicators. The moving average are called the trending indicators, and this one is called oscillators. It's primarily used in a trading range. So what are the principles of RSI? Simply speaking, when the RSI is above 70, the underlying is overbought and may pull back. And when the RSI is below 30, the underlying is oversold and may rebound. But of course, this is in a perfect case, mainly for ranging market. If the market is in a trending mode, then the RSI may stay for a long time in the oversold or overbought boundary. So we have to combine the moving average or the trending indicators when the market is in a perfect trend. So let's see this left example. As you can see, the lower half is the 15-period RSI, relative strength index. So as you can see, when the price reached new high in February 2012, the RSI failed to break new high. This is called bearish divergence, which means price new high, but the momentum cannot reach new high. Or in some other words, you can think that the price don't have momentum to go further upside. So later, in early March, when the price dropped below the previous top, at the previous low, and the RSI dropped below the previous, as you can see, there is a rising trend line. When the RSI dropped below this rising trend line, we are confirmed that the uptrend is reversed. So in this sense, we can see the RSI is a leading indicator. When the price reached new high, but the RSI failed to reach new high, we have a bearish divergence, and this is before the price dropped. So if we combine this leading indicator and the moving average, the lagging indicator, we can have a much better trading results. This chart basically says the same thing. You can see the overbought boundary is above 70 and the oversold boundary is below 30. So we won't repeat here again. Let's see how to combine those technical tools, including moving averages, RSIs, trends, resistance, supports, how to combine them. Here are some reasons and advantages of combining the tools. As you can see, there are many disadvantages. As you can see, you can optimize the timing. Timing is extremely important for a trader, and you can improve your price targets, or you can reduce the false signals. So you combine the tools as filters to reduce the false signals. Let's jump to an example. Here is the same chart, the same Aussie dollar chart we used previously. So firstly, let's take a look at the blue line, which is the 50-day moving average. We can see this moving average is a representation of the price trends. If you remember, we have three categories of trends: the uptrend, sideways, and downtrends. This moving average basically catch all the three trends. In the first half, we have a rising moving average, it's uptrend. And in the middle part, we have a flat moving average, which means it's a trading range. And after September, we have a declining moving average, which say a downtrend confirmed. Now, the second use of moving average to generate trading signal. As you can see, the middle red line is the 20-day moving average. When the 20-day moving average cross below the 50-day moving average in August last year, we have a major sell signal. And after that, price dropped, well, as much as you can hope. And we look for the lower half is the RSI indicator. Basically, this indicator is capped by a declining trend line. So this also confirmed the bearish view on this pair. Even in September, as you can see, when the price tried to bounce against the moving average, the RSI is also capped by this declining trend line. And the price failed to bounce new high. So it's very important to combine all these tools and to make better trading decisions. So to sum up, through today's webinar, we hope that you can recognize the value of technical analysis as a decision-making tool. Technical analysis can provide buy or sell signals and trading ideas, and to help you timing the market. And unlike fundamental analysis, because technical analysis can be applied to different time horizons or different types of markets. So this is one additional benefit of learning technical analysis. And of course, you can apply technical analysis to different markets. Well, we cannot cover every aspect of technical analysis in today's short webinar. And if you are interested to learn more about technical analysis, it's always a good start to read some classic books. So here we list 4 classic technical analysis books, and especially the first one, The Technical Analysis of the Financial Markets by John Murphy. So this book is known as the Bible of technical analysis. I think every serious technical analyst should read this book for more than once. So I think this is the end of today's webinar, and I'd like to thank Formax for inviting us as the guest speaker. And if you want to contact the company Formax or Trading Central, here are the contact details. Once again, thank you everybody for attending today's webinar. And I think we have 10 minutes for the Q&A session. Right? Swami, are you there?
Yeah, hi Lee.
Hi, Swami.
Yeah. So anyone if want to ask any question, please. If you have any doubt, any query, you can write down there your questions. We will get to know.
Yeah, you can simply type your questions on the dialog or ask the question.
Yeah, 1 second. Yeah, Shikha.
Yeah, hi Shubham.
Yeah, you can ask your question.
Yeah. Hello Mr. Lee, how are you?
Hi, how are you?
I'm good. Mr. Lee, I would like to again know the concept of RSI, as you have been telling that what is the overbought level and what is the oversell level, that is the between 70 and 30 or above 70 or below 30. So can you please explain that slide again?
All right, no problem.
Yeah.
Let's come to the slides for RSI. Okay, can you see this slide?
Yeah.
Actually, we have a formula here for calculating the RSI because it counts the average rise and average drops of the underlying assets for the past, say, 14 days. So if we have 14 up days, then the RSI is 100. And if we have 14 down days, the RSI should be 0. But this is very rare in real market situation because we don't have a continuous up market or continuous down market. However, if the market is up for, say, 7 days, it's a neutral market because it's up for half of the time and down for half of the time, it's neutral. But if the market is up for, say, 10 days but down for only 4 days, then we have a RSI reading higher than 50. 50 is the neutral area of the range. So why the number 70 and 30? I believe your question is this. This is basically based on the user's experience. Of course, many users want to have less signals. Then they will use 20 and 80 to select trades. Can you understand? Hello?
Hello.
Hello? Have I explained the question?
Yeah, Mr. Lee, but then there's one more question which I would like to know. Like as you said, like if the trading range is above 70, so is it a signal that there would be a downtrend? Like if the trading is like if the RSI is above 70, so like the signal would be of downtrend.
Okay.
You mean to say?
Okay, I got your second question. Let's use this left chart for an example. As you can see, in January 2012, when the RSI reached 70 for the first time, can you see that?
Yes. Yes.
Then the RSI dropped below. It failed to maintain the overbought region.
Okay.
Of course, we can see the price also dropped below, right? And then in February, when the RSI stayed above 70, you can see the price keep on going. Why? Because it's a very strong uptrend market. So, hello? Hello?
Hello, can you hear me?
Yeah.
Okay.
Okay. So as a trader, we have to be very cautious when we using the overbought number. We cannot say if the number is 70, we can sell without identify our risk. Always find initial risk when you enter the market, and never rely on a single reading of the technical indicator. And I think that's the final conclusion when you're using the 70 or 30 numbers.
Like, so to sum up, Mr. Lee, to sum up with this, like if the market, if the RSI of the market is above 70, so there's a strong call that the market would be making a downtrend, right? If I'm not wrong, what I have got from your conversation and as per my understanding. Is it like this?
Yeah.
Like if the RSI is above 70, so there could be a strong call that the market would be making a downtrend. And if in case the RSI above 30, below 30, again there's a strong call that market would be above, like the market would be on uptrend, right? If I'm not wrong.
You're right.
Sum up with this point.
Hello?
Mr. Lee, can you hear me? Can you hear me, Mr. Lee?
No, there is some noise over on your side.
Hello.
Hello, Somami, right?
I think.
Hello.
Yeah, I think you got your answer. So can we move ahead to second question, Mr.
There's one.
Yeah.
No question.
Yeah.
Mr. Lee, can it be asked?
Yeah, you can go ahead.
Sure. Hello? Sure.
Yeah. Mr. Lee, you also explained the concept of the moving averages. So, like if I'm using the time frame of 1 hour, and if I have to find out the moving average of that time bar, so we need to add on the close price of that 10 bars and divide it by 10 for 1 hour chart. Or the moving averages would be able to find out on day 1 charts.
Yeah, the reason why people use the 10-day moving average in the past, because you can simply move the decimal of the sum of the past 10 days price. So it's very easy to calculate. But nowadays, you can use any number you want.
You mean to say, so in order to find out the 10 days? Okay. So it should be added off day 1 time frame, right? For the day 1, like the day 1 time frame, the close price of all the days should be summed up. Close price, right? And then divided by 10. So that
you are right. Most people use the closing price to calculate the moving average. But of course, some people also use the middle price, say the half of the high and low. You add the high and low and divide by 2. Is a middle price of
and then they add all the prices of all the 10 days. But then, Mr. Lee, how we can judge like the market would be on uptrend or the low trend? Like fine, this you told how to calculate the moving average, but how can we get to know the trend or the signal for that?
Well, it will be very difficult if we want to forecast the direction of the moving average. But the good news is we can simply follow the signal of the moving average. But you can see on this chart that both 20-day and 50-day moving average are declining. So it's a downtrend.
Okay.
Yeah, we don't try to forecast the direction of the moving average. Is a very dangerous try, but of course if you have a better method you can forecast, but we suggest we simply follow the moving average, but and when the price reach say in this example, when the price reaches the oversold area, say the RSI is below 30, we may consider close our short position even though the trend is still down, because we expect a short-term bounce in place.
Mr. Lee.
Hi.
Yeah, I'm so sorry to interrupt, Sikha, but I think few more clients have some questions. I think we can go ahead with them as well. Mr.
Sure.
Yeah, Mr. Robin is there. Yeah, Mr. Robin, can you hear me?
Yeah.
Yeah, please ask your question.
Yeah, what will be the right time zone for intraday, maybe the time zone of around 3-4 days waiting? I mean, holding
Yeah,
time can
hello?
be around 3-4. Yeah.
Hello,
Uh,
Robin.
sup-
Mm.
yeah. Suppose if my holding time period is around 1 week, what time frame should I use for the indicators?
Now, if your trading period is 1 week, you cannot use a monthly chart, right? You can,
Right.
yeah, you have to use, say, intraday chart, say 3-hour chart, right?
Okay.
Yeah. If you use a 3-hour chart, you can have a 50 period, that is 150-hour moving average, or you have a 100-hour period moving average, which is 300 hours moving average.
Okay.
Yeah.
Thank you, sir.
Yeah,
No
thanks,
problem.
Lee. And Mr. Anil, are you there? Mr. Anil has a question, I think. Mr. Anil Patil.
Yes, Anil is. Good afternoon, sir.
Yeah, go ahead.
Hello. Good afternoon.
Yeah, good afternoon. I have two questions. First is, what would be the right combination of indicators? Like you said here, moving average with RSI. Is there any other combination of indicators that you would suggest us?
Yep. So let me answer your first question before you raise the second one.
Yes, sir.
So why we choose moving average and the RSI here, as I have explained during the webinar, the moving average is a trending indicator. It measures the trend, and the RSI is the oscillator, which measures the momentum of the price. So these two indicators are different. And if, say, we use a 10-day moving average and 11-day moving average, it doesn't make any sense. We have to use different types of moving average.
Yes, sir.
Yeah. Of course, you
Sir.
don't have to use, say, a simplified moving average, or the RSI for sure. You can have other indicators, but these two type of indicators are the most common one used by the traders.
Sir. Thank you, sir. The second question is, may we get a copy of this PPT on our email along with the voice recording so that we can revise afterwards? I would like to put this question to the organizers.
Yep.
Thank you, sir. Thanks a
Yeah,
lot.
we can send
No
it to
problem.
you.
You're
You just
welcome.
drop a mail to our email ID. We will let you know about that. Okay, and that last
Thank you, sir.
question, yeah,
Thank
it's
you.
okay, it's okay. And we have a last question from Mr. Tavares. Are you there, Mr. Tavares? Hello, Mr. Violet Tavares. Can you hear me? I think he is not online. Okay, so we can wipe out here. So Mr. Lee, thank you so much for your contribution and so insightful answers. And
Yeah, sure.
this is our address. If anyone have any kind of questions, they can write down to info@formaxmarket.com, and you can make a call as well, +91 022 264 642346. So thank you so much everyone, Mr. Lee as well. So
Yeah,
have a
sure.
good day. Fine.
Have a nice weekend. Yeah, bye.
Bye.